There is a powerful, almost paradoxical truth at the heart of building monumental wealth. The truth so contrary to conventional wisdom that most investors will spend their entire lives actively working against it. They will hear the advice, they will nod in agreement, and then they will immediately return to the very behaviors that guarantee mediocrity. This truth is not hidden in some complex formula or a secret algorithm traded among the financial elite. It was laid bare decades ago by a man from Omaha, Nebraska, a man who built an empire not on frantic activity, but on profound stillness, not on owning hundreds of things, but on understanding a handful of things better than anyone else on earth. The principle is devastatingly simple. He said, "I could improve your ultimate financial welfare by giving you a ticket with only 20 slots in it, so that you had 20 punches, representing all the investments that you got to make in a lifetime. And once you'd punched through the card, you couldn't make any more investments at all." Think about that. 20 decisions. Not for a year, not for a decade, but for your entire life. Suddenly, the casual, almost trivial way most people approach investing is revealed for the reckless gamble it truly is. Buying a stock because of a headline, a tip from a friend, or a gut feeling becomes an act of breathtaking irresponsibility. Each punch on that card is a piece of your financial soul, a commitment of capital so significant it must be treated with the gravity of a life-altering choice. This is the 20-slot punch card, the mental model that separates the amateur from the master, the dabbler from the dynasty builder. It is the sworn enemy of the most pervasive and wealth-destroying habit in modern portfolio management, the disease of diversification. That is the act of spreading your capital so thin across so many different stocks, funds, and assets that you effectively guarantee you will never achieve anything more than the lukewarm, uninspired average. Your brilliant ideas, your one or two true insights, are drowned in a sea of mediocrity. The winners are shackled to the losers, and your portfolio goes nowhere, slowly. This is the safe path, the comfortable path, the path of the 99%. It is a strategy designed not to lose, which is a very different thing from a strategy designed to win. Today, we are rejecting that path. We are embracing the terrifying, exhilarating discipline of the punch card. We will deconstruct this philosophy into 5 foundational pillars, and by the end of our journey, you will not just understand this principle. You will be armed with a complete blueprint to transform your approach to capital allocation, to move from a collector of stocks to a creator of wealth. You will learn to think not like a retail investor, but like a capital-deploying chief executive, making fewer, better, and bigger decisions that have the power to fundamentally reshape your financial future and achieve a state of true financial freedom. This is not another list of hot stock picks. This is an upgrade to your mental software, a permanent installation of a professional-grade investment strategy. This is the final promise of focus investing. Our first pillar, the very bedrock upon which the entire punch card philosophy is built, is the mandate of extreme selectivity. This isn't just about being picky. It's about cultivating a level of discernment so severe, so ruthlessly uncompromising, that it borders on paranoia. The punch card is not a tool for finding good investments. It is a filter designed to reject them. Its primary function is to say no. It forces you to say no to good ideas, to intriguing ideas, to popular ideas, all in the patient, disciplined hunt for the truly great idea. The scarcity of those 20 slots changes everything. It elevates the standard of what constitutes an acceptable investment from "this will probably go up" to "this is so overwhelmingly compelling that I am willing to sacrifice 1/20th of my life's financial decisions to own it." This mental shift is the first and most critical step towards escaping the gravitational pull of average returns that traps the vast majority of market participants. It is the conscious decision to trade the illusion of safety found in numbers for the profound security found in deep, unshakable knowledge of a select few positions. To truly grasp the power of this mandated selectivity, we must travel back to 1963. The world of finance was a different place, a clubbier, less scrutinized world. And at the center of it was a titan, American Express. They were not just a credit card company, they were the gold standard of financial trust. Their traveler's checks were as good as currency anywhere in the world. Their reputation was pristine, seemingly indestructible. But beneath the surface, a cancer was growing in one of their smallest, most obscure subsidiaries. This was the Allied Crude Vegetable Oil Refining Corporation, a company in Bayonne, New Jersey, run by a man named Tino De Angelis. Allied had a simple business. They stored vegetable oil. Companies would deposit their oil in Allied's tanks, and Allied would issue warehouse receipts for that oil. These receipts were then used by the companies as collateral to get loans from banks, and American Express, through its warehousing division, would guarantee the validity of those receipts. It was a mundane, boring business, which is exactly why no one was paying close attention. Tino De Angelis, however, was a fraudster of breathtaking genius. He discovered that he could fill his massive storage tanks mostly with water, with only a thin layer of valuable salad oil floating on top. When inspectors came to check the inventory, they would dip their testing tubes from the top and find exactly what they were looking for. Based on these falsified inventories, Allied was issued warehouse receipts for millions and millions of pounds of oil that simply did not exist. They then used these fraudulent receipts, all guaranteed by the unimpeachable name of American Express, to secure over $150 million in loans from 51 different banks and companies. In November of 1963, the House of Cards collapsed. Allied Crude Vegetable Oil filed for bankruptcy, the fraud was exposed, and Wall Street was plunged into chaos. The scandal, which became known as the Salad Oil Scandal, was a direct, devastating blow to the heart of American Express. The market's reaction was swift and brutal. Panic ensued. How could this have happened? If American Express couldn't be trusted to properly oversee a simple warehousing operation, how could anyone trust their travelers' checks? The very foundation of their business, their reputation for absolute integrity, was shattered. Wall Street analysts, investors, and the financial press declared that the company was ruined. They believed American Express would be legally liable for the full $150 million in fraudulent loans, a sum that would wipe out a significant portion of the company's net worth. The stock, which had been trading at over $60 a share, plummeted to $35. The herd was stampeding for the exits. This was a crisis of confidence, the single most dangerous thing that can happen to a financial institution. But in Omaha, Nebraska, a young Warren Buffett was watching with intense curiosity. While the rest of the world was panicking, he was asking a different set of questions. This is where extreme selectivity begins, not with a spreadsheet, but with a temperament that runs contrary to the crowd. He didn't see a ruined company. He saw a potential opportunity of a lifetime, one of those rare moments where a great business is put on the sale rack due to a temporary, albeit terrifying, problem. He knew this could be one of his 20 punches, so the standard for investigation had to be astronomical. He didn't just read the newspaper reports. He engaged in what is now famously called scuttlebutt research. He started with the numbers. He analyzed American Express's balance sheet and determined that even if they were on the hook for the entire fraud, the company was financially strong enough to survive the blow. It would be painful, but not fatal. The market was pricing in bankruptcy. Buffett's analysis suggested resilience. But that wasn't enough for a punch-card decision. He had to understand the core business, the one that truly mattered, the traveler's checks and credit cards. Was the damage to the brand permanent? Had the scandal truly eroded the public's trust? To answer this, he didn't rely on Wall Street analysts. He went directly to the source. He walked into local banks and Omaha steakhouses. He talked to cashiers, to hotel clerks, to travel agents. He would ask them, "Have you noticed any change in people using American Express travelers' checks since the scandal?" He would observe customers at the checkout line. Were they still pulling out that iconic green card? The answer he got, over and over again, from the real world, from the front lines of commerce, was a resounding no. People were still using the cards, banks were still accepting the checks. The durable competitive advantage, the moat of trust built over decades in the minds of millions of consumers, was holding firm. The market was panicking about the headlines. The underlying business reality was unchanged. Armed with this deep, selective, first-hand knowledge, Buffett acted with conviction. He began aggressively buying shares of American Express. Between 1964 and 1966, his investment partnership allocated a staggering 40% of its entire capital to this single stock. 40%. This wasn't a small speculative bet. This was a punch on the card. He was betting the farm on his differentiated insight. He had said no to hundreds of other investment ideas to say this one, massive yes. The result is history. As the fear subsided and it became clear that American Express would not only survive but thrive, the stock soared. Buffett's partnership made a fortune. This single, highly selective decision, born from a contrarian viewpoint and verified through obsessive, on-the-ground research, became one of the foundational legends of his career. It perfectly illustrates the mandate of extreme selectivity. While the world was diversifying away from the tainted stock, Buffett was concentrating into it, armed with a degree of knowledge that turned what looked like a reckless gamble into a near certainty. He used one of his precious 20 slots, and he made it count. The psychological principle that makes Buffett's approach so potent and the average investor so weak is a dance between two powerful cognitive forces, the scarcity heuristic and decision fatigue. Our brains are wired with a simple shortcut. If something is scarce, it must be valuable. This is why limited edition products command premium prices, and why last chance offers spur us to act. The 20-slot punch card brilliantly hijacks this innate heuristic and applies it to our financial lives. By artificially creating an extreme scarcity of investment decisions, it forces our brain to elevate the perceived value of each one. You no longer treat a stock purchase as a casual transaction. You treat it as the deployment of a rare and precious resource. This mental shift is automatic and profound. It triggers a higher level of cognitive engagement. You simply think harder and more critically when you know you can only do something 20 times in your life. Conversely, the path of the 99% is a fast track to a state of chronic decision fatigue. This is a well-documented psychological phenomenon where the quality of your decisions deteriorates after a long session of decision-making. Think of a judge who is more likely to deny parole in the afternoon than in the morning, or a shopper who makes impulsive, poor choices at the end of a long trip to the supermarket. The modern investing landscape is an engine of decision fatigue. You are bombarded with thousands of stocks, endless financial news cycles, and countless experts shouting buy and sell recommendations. The typical retail investor attempting to manage a portfolio of 30, 40, or 50 stocks is in a perpetual state of low-grade decision fatigue. They are forced to make dozens of small, inconsequential decisions. Should I sell this one that's down 5%? Should I buy a little more of that one I heard about on TV? Each of these little choices depletes a finite reserve of mental energy and willpower. The result is a portfolio built not on rigorous analysis, but on a series of tired, impulsive, and emotionally driven compromises. Diversification is the financial embodiment of decision fatigue. It is the result of making too many decisions, none of which are given the focused, high-energy attention they deserve. The punch card is the ultimate antidote. It eliminates the noise and the fatigue by forcing you to focus all your mental energy on just a handful of high-stakes choices. You are no longer managing a sprawling, chaotic garden of weeds. You are cultivating a small, select group of mighty oaks. The scarcity of the slots preserves your most valuable asset, your capacity for high-quality thought. So how do we translate this into a practical, repeatable process? We can use a mental model I call the three-box system. This is a blueprint for implementing extreme selectivity in your own investment process, a way to move from theory to action. Imagine 3 physical or digital boxes in front of you. Box 1 is labeled in, Box 2 is labeled out, and Box 3 is labeled too hard. The goal of your investment research process is to sort every potential idea into one of these 3 boxes as quickly and ruthlessly as possible. The secret to success with this system lies in the size of the boxes. Box 2, the OT box, should be enormous. virtually infinite. This is where 95% of all ideas should go, immediately. A company with a bad balance sheet? Straight to the OT box. A business model you can't explain to a 10-year-old in 2 minutes? Out. A management team with a history of questionable ethics? Out. An industry undergoing rapid, unpredictable technological change? Out. You must become a master of the quick rejection. Your default answer to any new idea must be no. This step alone will protect you from the vast majority of investment mistakes. And, just as importantly, it will preserve your precious time and mental energy. Box 3, the too hard box, is for companies that seem interesting and potentially high quality, but operate in areas outside of your current circle of competence. This is a crucial box for maintaining intellectual honesty. Perhaps it's a complex biotechnology firm or a semiconductor designer. You recognize its potential, but you also recognize your own ignorance. You don't understand the competitive landscape or the key drivers of its success. Putting it in the too hard box is not a failure. It is an act of supreme discipline. It is an acknowledgement of your own limitations. Over time, you can choose to do the hard work of learning about a specific industry to move a company from the too hard box. But it should be a deliberate, multi-year effort, not a casual whim. Finally, we have Box 1, the IN box. This box is tiny. It should be incredibly difficult to get a company into this box. To qualify for the IN box, a company must first pass a brutal gauntlet of criteria. First, it must be squarely within your circle of competence. You must understand its business, its customers, its competitors, and its long-term prospects intimately. Second, it must have a long-term, durable competitive advantage, a wide moat that protects it from competition. Third, it must have a management team with both integrity and talent. And fourth, it must be available at a price that offers a significant margin of safety, a deep discount to its intrinsic value. Only when an idea has cleared all of these hurdles can it even be considered for the IN box. This is the pool of candidates for one of your 20 punches. The 3-box system transforms you from a passive recipient of ideas into an active, aggressive filter. It enforces the mandate of extreme selectivity and ensures that by the time you are ready to punch your card, you are choosing from a tiny list of the absolute highest quality, most well-understood opportunities available. To truly understand the power of this model, we must examine its opposite, the antithesis, the path of the 99%. This is the path of the stock collector. We all know this person. Their portfolio is not a portfolio. It's a chaotic menagerie, a random collection of 50, 60, or even more stocks. Ask them why they own a particular company, and you'll get a vague, uncertain answer. My brother-in-law told me about it. I saw a positive segment on a financial news channel. I like their products. It was going up, so I bought some. The stock collector has no coherent investment philosophy. Their process is driven by impulse, emotion, and the fear of missing out. They are the personification of diversification. Let's imagine a stock collector named Dave. Dave has $100,000 to invest. He reads headlines and wants to be diversified, so he buys a little bit of everything. He buys $2,000 of a hot tech stock, $2,000 of a legacy industrial company, $2,000 of a speculative biotech, $2,000 of a bank, and so on, until he has 50 different positions. He feels safe. He feels diversified. Now let's say Dave gets one right. One of his $2,000 bets, against all odds, turns out to be a massive winner. The speculative biotech company gets a drug approved, and its stock goes up tenfold. His $2,000 investment is now worth $20,000. He made a profit of $18,000. It feels incredible. But what is the actual impact on his total portfolio? His entire portfolio went from $100,000 to $118,000. A great result, but hardly life-changing. Meanwhile, 10 of his other $2,000 bets went down by 50%, wiping out $10,000 of his capital. Another 20 of them just treaded water, going nowhere. His one brilliant pick, his lottery ticket winner, was so diluted by the sheer number of his other mediocre holdings that its impact was muted. The stock collector's strategy is a mathematical guarantee of mediocrity. It's like trying to win the Kentucky Derby by betting $1 on every single horse in the race. You might be able to say you picked the winner, but you will not make any real money. The path of the stock collector is a path of frantic activity that leads to financial stagnation. The direct financial connection of extreme selectivity is both profound and often overlooked. It manifests in two powerful hidden ways: drastically lower transaction costs and superior tax efficiency. Every time you buy or sell a stock, you incur a cost. It might be a direct commission, or it might be the hidden cost of the bid-ask spread. For the hyperactive stock collector, these small costs add up to a significant drag on performance over time, a constant, abrasive friction that grinds away at their returns. The practitioner of the 20-slot punch card, by contrast, might make only one transaction every 2 or 3 years. Their transaction costs over a lifetime are negligible. But the real game-changing advantage is tax efficiency. In the United States and many other countries, you pay capital gains taxes when you sell an asset for a profit. For the stock collector who is constantly trading, trimming positions, and rebalancing, a significant portion of their gains is surrendered to the tax authority each year. This is a catastrophic leak in the compounding engine. Let's say you have an investment that doubles. If you sell it, you might lose 20 to 30% of your profit to taxes, permanently reducing the capital you have available to reinvest for future growth. The focus investor, however, who buys a great business with the intention of holding it for decades, avoids this trap. Their gains are allowed to compound year after year, decade after decade, on a pre-tax basis. This is a monumental advantage. Albert Einstein supposedly called compound interest the 8th wonder of the world. Tax-deferred compounding is like the 9th. By simply refusing to sell, by having the discipline to make a highly selective purchase and then sit on it, the focus investor unleashes the full, untaxed, unhindered power of compounding. This silent, invisible benefit, created directly by the mandate of extreme selectivity, can be the difference between a comfortable retirement and the creation of true, generational wealth. The second pillar that supports the punch card philosophy is the power of deep competence. If the first pillar forces you to be selective, this second pillar demands that your selectivity be rooted in genuine, verifiable expertise. You cannot simply pick 20 random companies. You must pick 20 companies that you understand with a level of intimacy that would rival the company's own CEO. This is the concept Warren Buffett famously calls the circle of competence. The idea is simple. Each of us, through our experiences, education, and interests, has built up a certain amount of knowledge in specific areas. It might be retail, banking, software, or manufacturing. The size of that circle is not important. What is critically important is knowing its boundaries and staying strictly within them. The punch card philosophy is unworkable without this intellectual honesty. A concentrated portfolio of businesses you don't understand is not a high-conviction strategy. It is a ticking time bomb. Deep competence is the safety mechanism. It is the research, the knowledge, and the insight that transforms a concentrated bet from a wild gamble into a calculated, high-probability investment. True wealth in the market is not built by predicting the future, but by understanding the present so deeply that you can identify businesses that have a high probability of success regardless of what the future holds. There is no better illustration of operating within a circle of competence than Warren Buffett's investment in the Coca-Cola Company in 1988. This was not a small position. Over the course of several months, he invested over $1 billion, which at the time represented more than a quarter of Berkshire Hathaway's entire portfolio. This was a massive, concentrated bet. It was a definitive punch on his card. But to understand why he had the confidence to do this, you have to understand that this was an investment he had been researching, unofficially, for his entire life. Buffett's connection with Coca-Cola began in his childhood. As a boy in the 1930s, he would buy 6 packs of Coke for 25 cents and sell the individual bottles for a nickel each, pocketing a 5-cent profit. He was, in his own small way, a Coca-Cola distributor. He saw firsthand the simple, repeatable economics of the business and the consumer's desire for the product. For the next 50 years, he was a loyal and observant customer. He personally consumed quarts of the sugary beverage every day. He joked that he was 1/4 Coca-Cola. But his analysis went far beyond his own consumption habits. He watched the company's relentless global expansion. He saw Coca-Cola signs in the most remote corners of the world. He understood that the brand was not just a name, it was a psychological trigger, an icon of American culture that represented happiness and refreshment to billions of people. This was a brand equity that had been built over a century, an asset that didn't appear on the balance sheet, but was more valuable than all the company's factories and bottling plants combined. He had been studying its annual reports for years, admiring the consistency of its growth, its high profit margins, and its simple, capital-light business model. Coke didn't need massive investments in research and development. It didn't need to constantly reinvent its core product. Its primary task was to defend and expand the mental real estate it occupied in the minds of consumers. The moment to act came after the stock market crash of October 1987. In the ensuing panic and volatility, Coca-Cola's stock, along with the rest of the market, became significantly cheaper. While others were fleeing the market in fear, Buffett saw the opportunity he had been patiently waiting for. He saw a chance to buy one of the greatest, most understandable businesses in the world at a reasonable price. His deep competence gave him a clarity that was unavailable to the average investor. He knew the business wasn't 30% less valuable just because the stock price had fallen 30%. He understood the durability of its moat. A competitor could create a new cola, but they could not create another Coca-Cola. They could not replicate the century of memories, advertising, and global distribution that made Coke the default choice for billions. He had a simple thought experiment. If you were given $100 billion and told to unseat Coca-Cola as the world's leading soft drink provider, could you do it? He concluded that you could not. You could spend all the money in the world, but you could not dislodge that brand from the human psyche. This was the ultimate sign of a durable competitive advantage. His purchase of Coca-Cola was the culmination of 50 years of observation and study. It was a decision made from the absolute center of his circle of competence. He wasn't guessing about the future of technology or speculating on a new drug. He was betting on one of the most stable and predictable phenomena in the business world, the human desire for a simple, consistent, and enjoyable product. That deep, lifelong competence gave him the courage to make a $1 billion bet, a bet that has since compounded into one of the most successful investments of all time, generating tens of billions of dollars in value for Berkshire Hathaway shareholders. It is the perfect marriage of a concentrated punch-card decision with the profound power of deep competence. The psychological trap that deep competence helps us to avoid is one of the most insidious biases in human cognition. The Dunning-Kruger effect. This is a cognitive bias whereby people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. The world of investing is a veritable playground for the Dunning-Kruger effect. A person who has read a few articles online and watched some cable news can quickly develop a dangerously inflated sense of their own stock-picking prowess. They buy a few popular tech stocks, and if those stocks happen to go up in a bull market, their overconfidence soars. They mistake luck for skill. This is what a professor of psychology might call the peak of Mount Stupid. The strategy of diversification not only enables but actively encourages an investor to live on the peak of Mount Stupid. By owning 50 different stocks, you create the illusion of knowledge. You can speak superficially about dozens of industries. You know a little bit about a lot of things. But you lack the deep, nuanced understanding of any single one of them. This makes you incredibly vulnerable. When a crisis hits one of your companies, you have no foundation of knowledge to fall back on. You don't understand the balance sheet, the competitive pressures, or the long-term strategy. All you know is that the stock is going down, and your brain's fear response kicks in. You are likely to panic and sell at the worst possible moment, precisely because your knowledge is a mile wide and an inch deep. The pursuit of deep competence, as demanded by the punch card philosophy, is a journey off of Mount Stupid. It forces you to descend into what is known as the Valley of Despair. This is the humbling process of realizing how little you actually know. As you begin to study a single company or industry in earnest, you are confronted with the vastness of your own ignorance. It's a painful but necessary step. Only by pushing through this valley, by continuing the hard work of learning, can you begin to climb the slope of enlightenment, where your confidence becomes calibrated to your actual expertise. A concentrated portfolio is a testament to this journey. It is a public declaration that you have left the peak of Mount Stupid behind, that you have chosen to be a true expert in a few things rather than a confident amateur in many. To build this expertise, we need an applied mental model, a practical blueprint. I call it the Annual Report Challenge. This is a method for transforming the way you read a company's 10K, its official annual report filed with the Securities and Exchange Commission. Most investors, if they look at it at all, just glance at the summary numbers. The challenge is to read it not as a speculator, but as if you were about to buy the entire company outright with your family's entire net worth. This shifts your perspective from passive observer to prospective owner. The challenge consists of answering a specific set of questions before you are allowed to even consider investing. First, go to the business section. Your task is to rewrite this section in your own words, in simple language, as if you were explaining it to a friend who knows nothing about business. If you cannot do this, you have failed step 1. The business is outside your circle of competence. Put it in the too hard box. Second, read the risk factors section. Most people skip this boilerplate. You must not. Your task is to identify the top 3 risks that you believe are most likely to permanently impair the company's earning power. Then you must write a paragraph on how the company is mitigating each of those risks. Third, go to the Management's Discussion and Analysis, MD&A. This is where the leadership team tells their story of the year. Your challenge is to read it with a skeptical eye. Is the language clear and straightforward, or is it filled with jargon and obfuscation? Do they admit their mistakes, or do they only talk about their successes? A great management team speaks in plain English and takes responsibility. Finally, you must tackle the financial statements, the balance sheet, the income statement, and the cash flow statement. You don't need to be a certified public accountant, but you need to understand the narrative they tell. For the balance sheet, your task is to track the level of debt over the past 5 years. Is it growing faster than equity? That's a red flag. For the income statement, look at the gross margins. Are they stable or increasing? This can be a sign of a strong competitive moat. For the cash flow statement, compare the net income to the cash from operations. If a company consistently reports high profits but isn't generating actual cash, something is wrong. Completing the annual report challenge for a single company is a significant undertaking. It might take you 10 or 20 hours. But that is precisely the point. The sheer effort required acts as a powerful filter. It forces you to build deep competence and makes it impossible to become a stock collector. You simply don't have the time to do this for 50 companies. But you do have the time to do it for the handful of businesses that might one day earn a spot on your 20-slot punch card. The antithesis to this deep work is the path of the ETF automaton. This is the investor who, recognizing their own limitations, decides to outsource all thinking to a passive index fund, like one that tracks the S&P 500. On the surface, this seems like a sensible strategy, and for many people who have no interest in business, it is indeed a far better choice than being a stock collector. It offers broad diversification and low costs. It is a guaranteed path to achieving the market average. But the punch card philosophy is not about achieving the average. It is a blueprint for decisively beating the S&P 500. The ETF automaton has traded the folly of individual stock collecting for the certainty of mediocrity. The hidden danger for the ETF automaton is that they have abdicated responsibility for understanding what they own. Their portfolio is a black box. In a roaring bull market, this feels fine. But when a true market panic arrives, like in 2008 or 2020, they are just as vulnerable as the stock collector. They don't know why they own what they own. They have no conviction rooted in deep competence. They see the value of their black box plummeting, and their only guide is the primal scream of the market, which is telling them to sell. The practitioner of focus investing, who has meticulously completed the annual report challenge for each of their 5 or 10 holdings, experiences a crisis completely differently. They understand their businesses, they have confidence in their long-term earning power. The market panic is not a source of fear. It is a source of opportunity, a chance to potentially add to their positions in great companies at fire sale prices. The ETF automaton is a passenger on a ship they don't understand, tossed about by the waves. The focus investor is the captain, with a deep knowledge of their vessel and a clear map to their destination, capable of navigating the storm with confidence. The direct financial connection of deep competence is its ability to help you identify and value a company's durable competitive advantage, or its moat. A moat is the structural feature of a business that protects it from competitors, allowing it to earn high returns on its capital for a very long period of time. It could be a powerful brand, like Coca-Cola's, a network effect like Facebook's, a low-cost production advantage like Geico's, or high switching costs like Microsoft's. Your ability to see and understand these moats is directly proportional to your level of competence within an industry. An amateur cannot see them. A generalist can only guess at them. But an expert, someone who has done the deep work, can identify them with a high degree of confidence. This is not just an academic concept, it has a direct and massive impact on a company's financial performance. A company with a wide moat is able to generate a consistently high return on invested capital, ROIC. This is a key metric that measures how efficiently a company is using its money to generate profits. A business that can consistently earn, say, a 20% ROIC, is a far superior investment to one that can only earn 6%, the average cost of capital. The high ROIC business is a compounding machine. It creates enormous value for its shareholders over time. A company without a moat will see its high returns competed away as rivals enter the market. The company with a moat can fend them off and continue to compound capital at a high rate. Deep competence is the tool that allows you to differentiate between the temporary high flyers and the truly durable compounding machines. By focusing your capital only on those businesses with wide, sustainable moats that you understand, you are statistically stacking the odds of long-term financial success overwhelmingly in your favor. Our third pillar is the courage of high conviction. If selectivity gives you the target and competence gives you the ammunition, then conviction is what allows you to pull the trigger, especially when everyone around you is telling you not to. High conviction investing is the emotional and psychological core of the punch card philosophy. It's one thing to do the research and identify a great opportunity. It is another thing entirely to bet a significant portion of your net worth on it, and then have the fortitude to hold that position through the inevitable storms of market volatility. This temperament, this ability to act decisively, based on your own analysis, and then to sit patiently for years, even decades, is perhaps the rarest and most valuable skill in all of investing. Diversification is a balm for the uncertain. It whispers a comforting lie. It doesn't matter if you're wrong on any single one, because you own so many. Concentration offers no such comfort. It demands that you be right, and it demands that you have the guts to stick with your judgment when it is being tested. This courage is not born from arrogance or recklessness. It is the natural byproduct of the first two pillars, extreme selectivity and deep competence. It is the quiet confidence that comes from knowing you have done the work and that you understand the business better than the panicking crowd. To see this pillar in action, we turn to one of the most important and instructive stories in the history of Berkshire Hathaway, the acquisition of See's Candies in 1972. At the time, Warren Buffett was still firmly in the cigar butt phase of his investing career, a style he learned from his mentor Benjamin Graham. He was looking for cheap stocks for businesses trading at a deep discount to their liquidation value. See's Candies was not that. The founding See family wanted $120 million for the company, but it only had about $8 million in tangible assets. This meant they were asking for a massive premium, something called goodwill, which was the value of the brand and its reputation. For the Buffett of that era, paying for goodwill was anathema. It violated the core tenets of his Graham-inspired training. However, his partner Charlie Munger saw something different. Munger had been pushing Buffett to evolve, to understand that it was far better to buy a wonderful company at a fair price than a fair company at a wonderful price. Munger saw that See's was a truly wonderful company. It had a fanatically loyal customer base in California. It had a powerful brand that people associated with quality and nostalgia. And, most importantly, it had incredible pricing power. Because customers loved the product and trusted the brand, See's could raise the price of its boxed chocolates by a small amount each year, and people would happily pay it without a second thought. This small, incremental price increase went straight to the bottom line, creating a torrent of cash flow that required very little additional capital investment. Munger convinced Buffett to look past the high purchase price and focus on the quality of the business. They did their homework. They understood the simple economics of the candy business. They recognized the power of the brand. Ultimately, they made the deal, buying See's for $25 million. But this is where the courage of high conviction truly begins. The purchase itself was just the first step. The real test came year after year, as they had to resist the temptation to sell. In the years that followed, See's Candies became a cash-generating geyser for Berkshire Hathaway. It has since produced over $2 billion in pre-tax earnings for Berkshire, all from an initial $25 million investment that Buffett was initially hesitant to make. The conviction required here was twofold. First, there was the conviction to break from his old mental model and pay up for quality, a decision that was psychologically difficult for him. Second, and more importantly, was the conviction to hold it, to not sell it after it had doubled or tripled in value. The average investor, seeing such a quick and handsome profit, would have been sorely tempted to cash in their chips and lock in the gain. But Buffett and Munger understood what they owned. They had the conviction, born from their understanding of the business's pricing power and brand loyalty, to let this winner run. They knew that the true value of See's was not in a quick flip, but in its ability to compound capital over decades. This story marks a crucial turning point in Buffett's career. It was the training ground that taught him the immense power of owning a high-quality business with a durable moat. It gave him the intellectual framework and the psychological fortitude to later make even bigger, higher conviction bets on companies like Coca-Cola and American Express. The $2 billion in profit is a testament not just to a smart purchase, but to the 50 years of courageous conviction it took to simply do nothing and let a wonderful business work its magic. The psychological demons that high conviction forces us to conquer are loss aversion and its close cousin, regret aversion. Decades of research in behavioral economics, pioneered by Daniel Kahneman and Amos Tversky, have shown that for most people, the psychological pain of losing a certain amount of money is roughly twice as powerful as the pleasure of gaining an equivalent amount. This is loss aversion. Our brains are hardwired to avoid losses at all costs, even if it means taking irrational risks or foregoing rational gains. A concentrated portfolio magnifies the potential pain of loss aversion. If you own 5 stocks and one of them goes down 50%, the impact on your portfolio and your psyche is severe. If you own 50 stocks and one of them goes down 50%, you barely notice. This is why diversification feels so emotionally comfortable. It is a shield against the acute pain of being decisively wrong. Regret aversion is the fear of feeling the sting of a bad decision. It's what causes people to hold on to losing stocks for far too long, because selling would mean admitting they made a mistake and crystallizing the regret. It's also what causes them to sell their winners too early. They fear the regret of watching a stock that has doubled fall back to where they bought it, so they sell to lock in the gain, thereby avoiding that potential future regret. The punch-card investor must wage a constant war against these two powerful biases. They must be willing to look wrong in the short term. They must be able to withstand the psychological pain of watching a high-conviction position decline 20, 30, or even 50% without panicking. The only way to do this is to have a conviction that is not based on the stock's recent price action, but on a deep, fundamental understanding of the business's long-term value. Your conviction must be in your analysis, not in the market's daily mood swings. This requires a level of emotional detachment and discipline that is almost superhuman, a discipline that must be cultivated and practiced. To build this psychological armor, you can implement an applied mental model called the Pre-Mortem and Conviction Journal. This is a powerful two-part exercise that you must complete before you are allowed to purchase any stock. The first part is the pre-mortem. Imagine it is 1 year from today, and your investment in this company has been an absolute disaster. The stock is down 60%, and everyone is calling you a fool. Now you must write a detailed story explaining exactly what happened. What went wrong? Was it a new competitor? A technological disruption? A management scandal? A recession that hit their industry particularly hard? This exercise forces you to confront the potential risks of the investment head-on before you are emotionally invested. It moves the risks from the abstract to the concrete and helps you to see the investment with clear eyes. The second part is the conviction journal entry. On a separate page, you must write down, in as much detail as possible, the precise reasons why you are making this investment. What is your thesis? What is the company's durable competitive advantage? Why do you believe its intrinsic value is significantly higher than its current stock price? What are the key metrics you will be tracking over the next 5 years to validate your thesis? And most importantly, you must write a contract with your future self. It should say something like, I, your name, believe this company is worth X. If the stock price drops to Y, e.g., a 50% decline for reasons unrelated to a fundamental permanent impairment of the business's earning power as outlined in my pre-mortem, I will not panic. I will review my initial thesis, and if it remains intact, I will consider this an opportunity to buy more. This journal is your anchor in a storm. When the market is in turmoil and your emotions are running high, you can pull out this document. It is a message from your past, more rational self, reminding you of why you made the decision in the first place. It provides the logical foundation necessary to maintain conviction when your gut is screaming at you to sell. It is the practical tool for cultivating the courage that high-conviction investing demands. The antithesis of this courageous stance is the nervous seller. This is the investor whose actions are governed entirely by fear and regret. The nervous seller does just enough research to get excited about a company's story, but not enough to build true conviction. They buy the stock, often after it has already had a good run-up. Then, the inevitable happens. The company misses an earnings estimate, or the market enters a correction, and the stock drops 15 or 20%. The nervous seller has no foundation to stand on. Their superficial thesis has evaporated. The pain of loss aversion kicks in, and the fear of further losses becomes unbearable. They sell often near the bottom of the dip, telling themselves they are being prudent by cutting their losses. Then, a few months later, the temporary issue is resolved, the market recovers, and the stock soars to new highs, far above where they originally bought it. Now, the nervous seller is whipsawed by the pain of regret aversion. They regret selling, and they feel foolish. Their behavior has guaranteed the worst possible outcome. They bought high and sold low. This cycle repeats itself over and over. The nervous seller is constantly churning their portfolio, jumping from one idea to the next, never giving any single investment the time it needs to compound. Their portfolio is a graveyard of good ideas that were abandoned at the first sign of trouble. Their lack of conviction, born from a lack of deep competence, makes it mathematically impossible for them to build any significant wealth in the stock market. They are their own worst enemy, their portfolio's performance, a direct reflection of their emotional fragility. The direct financial connection of high conviction is its role as the guardian of the compounding process. Compounding is the engine of wealth creation, but it requires one crucial fuel: time. High conviction is what allows you to give your investments the time they need to work their magic. Let's look at a simple, powerful example. Imagine you invest $10,000 in a fantastic company. You have done your homework, and you have high conviction. Over the next 7 years, the company executes flawlessly, and your investment becomes a 10-bagger. Your $10,000 is now worth $100,000. The nervous seller at this point would be ecstatic and terrified. They would sell immediately to lock in that incredible gain. They have turned $10,000 into $100,000. It feels like a massive victory. But the high-conviction investor, who reevaluates their thesis and sees that the company's long-term prospects are still just as bright, does nothing. They let it ride. Over the next 10 years, the company continues to dominate its industry, and the stock becomes a 100-bagger from their original purchase price. Their initial $10,000 is now worth $1 million. The difference between the nervous seller and the high-conviction investor is not a small one. It is the difference between a nice one-time profit and true, life-changing wealth. The nervous seller made $90,000. The high-conviction investor made $990,000. That extra $900,000 was not generated by some brilliant new insight or a complex trading strategy. It was generated by the simple, courageous act of sitting still, of allowing the miracle of compounding to run its course, uninterrupted. High conviction is the psychological trait that allows you to capture the massive asymmetric returns that create generational wealth. Without it, you are almost certain to cut your flowers and water your weeds. This brings us to our fourth pillar, the mathematics of asymmetric upside. This is where we move from the qualitative aspects of business analysis and temperament to the cold, hard logic of portfolio-level returns. The punch card philosophy is not just an emotional preference, it is a mathematically superior strategy for wealth creation because of the unique nature of stock market returns. Returns are not evenly distributed. They don't follow a gentle bell curve. Instead, they follow a power law, a phenomenon often referred to as the 80/20ths rule, where a small number of events account for the majority of the outcomes. In investing, this is even more extreme. A tiny handful of superstar companies are responsible for the vast majority of the market's long-term gains. The goal of a superior investment strategy is not to capture the average. It is to structure your portfolio in such a way that you have the maximum possible exposure to these rare, outlier successes. Concentration is the only way to do this. Diversification, by its very nature, is a system designed to dilute the impact of these incredible winners, ensuring your portfolio will never truly capture their explosive, wealth-creating power. The foundational anecdote for this pillar is the story of Buffett's investment in Geico, the government employees' insurance company. This was not just a great investment. It was the investment that formed the bedrock of Berkshire Hathaway, transforming it from a struggling textile mill into the diversified powerhouse it is today. Buffett's involvement with Geico began long before he was a famous billionaire. As a young student at Columbia University in 1951, he learned that his hero, Benjamin Graham, was the chairman of Geico. On a Saturday, Buffett took a train to Washington, D.C., and banged on the door of Geico's headquarters until a janitor let him in. He eventually found a senior executive, Lorimer Davidson, who graciously spent hours explaining the insurance business to the eager young student. Buffett was immediately captivated. He grasped the brilliance of Geico's business model. By marketing directly to a select group of low-risk drivers, government employees, Geico could bypass the expensive agent network used by traditional insurers. This created a massive and sustainable low-cost advantage. They could offer lower prices than their competitors and still earn higher profit margins. Buffett understood that this was a powerful, durable moat. After that meeting, he put more than half of his personal net worth into Geico stock. It was his first experience with high-conviction, concentrated investing. He did extremely well, but sold it a few years later for a handsome profit, a decision he would later call a major mistake, as it violated the principle of holding on to a wonderful business. His second and much more famous chance came in 1976. The Geico that Buffett encountered then was a company on the brink of bankruptcy. In a misguided attempt to grow faster, the company had strayed from its core principles. It had started insuring high-risk drivers and had badly mispriced its policies. The company was hemorrhaging money, and its stock had collapsed from over $60 a share to just $2. Wall Street had left it for dead. The herd was convinced it was going to zero. But Buffett, armed with his deep, decades-long competence in understanding Geico's business, saw the situation differently. He knew the problem wasn't with the core business model. The low-cost advantage was still there. The problem was a temporary, fixable management mistake. He conducted his own rigorous investigation and concluded that the company's underlying franchise was still intact and immensely valuable. He saw an opportunity for a classic asymmetric bet. The term asymmetric is key. It means a situation where the potential upside is many, many times larger than the potential downside. In this case, Buffett reasoned that his downside was limited. He could lose his entire investment, which was the $2 per share he paid. But the upside was astronomical. If the company could fix its underwriting problems and return to its historical profitability, the stock could be worth 30, 40, or 50 times his purchase price. It was a situation of heads I win, tails I don't lose much. He began buying aggressively, eventually investing $47 million to acquire about one-third of the company. His investment provided the capital and the vote of confidence Geico needed to survive. A new CEO was brought in, the bad policies were purged, and the company returned to its disciplined, low-cost roots. The recovery was spectacular. By the mid-1990s, Buffett's initial $47 million investment was worth over $2 billion. He would eventually go on to buy the rest of the company, making Geico a wholly owned subsidiary of Berkshire Hathaway. This single investment, a high-conviction bet on an asymmetric opportunity, was responsible for a huge portion of Berkshire's early success. It demonstrates the mathematical power of finding one of those rare situations where the potential reward dwarfs the risk, and then betting big. The psychological principle at play here is probability neglect and the ambiguity effect. Our brains are not naturally good at processing probabilities, especially when it comes to rare, high-impact events. We tend to focus more on the magnitude of a potential outcome than on its actual likelihood. This is why people buy lottery tickets. They are captivated by the size of the jackpot, neglecting the infinitesimal probability of actually winning it. In investing, this works in reverse. Investors are often so terrified of the possibility of a large loss, even if it's a low-probability event, that they will choose a certain small gain over a probable, but not guaranteed, massive gain. This is a form of probability neglect. The ambiguity effect is our preference for known risks over unknown risks. We would rather choose an option where the probabilities are clear than one where they are uncertain, even if the uncertain option has a higher expected value. Diversification is a perfect example of this. An investor who buys an S&P 500 index fund knows, with a high degree of certainty, that they will get the market's average return, minus a small fee. It's a known, unambiguous outcome. A concentrated portfolio, on the other hand, is ambiguous. The range of potential outcomes is much wider. It could dramatically underperform the market, or it could dramatically outperform it. The average investor's brain, plagued by the ambiguity effect, shies away from this uncertainty and flees to the false comfort of the predictable average. The focus investor, however, understands that it is precisely in this ambiguity that the potential for asymmetric upside lies. They use their deep competence to reduce the ambiguity as much as possible, to turn an unknown risk into a calculated, understood risk. They are willing to embrace the uncertainty of a wider range of outcomes because their analysis shows that the probabilities are skewed massively in their favor. To systematically hunt for these opportunities, we can use an applied mental model called the 10x test. This is a simple but powerful filter to apply to any potential investment. The question is this: can you make a credible, well-reasoned case for this business being 10 times more valuable in the next 10 to 15 years? This is not about wishful thinking or wild speculation. It requires a rigorous analysis of the company's potential for growth and profitability. To pass the 10x test, a company typically needs to have several key characteristics. First, it needs a massive total addressable market (TAM). The company must be operating in a large and preferably growing market, giving it a long runway for expansion. A company that has already captured 80% of a small, stagnant market is unlikely to be a 10-bagger. Second, it needs a scalable business model. The company must be able to grow its revenue and profits without a proportional increase in its costs and capital expenditures. Software companies are a classic example of this. Third, it must have a powerful and widening competitive moat. What will stop competitors from flooding the market and eroding its profits as it grows? The 10x potential must be protected. Fourth, it must have significant reinvestment opportunities. The company must be able to take the cash it generates and reinvest it back into the business at high rates of return. A company that pays out all its earnings as dividends may be a fine investment, but it is unlikely to compound its value tenfold. Applying the 10x test is a difficult and humbling exercise. You will quickly discover that the vast majority of companies have absolutely no chance of passing it. It forces you to say no over and over again, but its true power lies in forcing you to focus your attention on the tiny sliver of businesses that possess the rare combination of qualities that can lead to extraordinary long-term returns. It is a tool for systematically identifying potential asymmetry. When you find a company that passes this test, and it is run by great management, and it is available at a reasonable price, you may have found one of the precious opportunities worthy of a punch on your card. The antithesis to this search for asymmetry is the dividend chaser. This is the investor who is obsessed with yield. Their primary, and often only, screening criterion for a stock is the size of its dividend payment. They are drawn to the allure of a regular, predictable cash payment. They will choose a slow-growing utility company with a 5% dividend yield over a fast-growing technology company with no dividend every single time. Their entire strategy is built around harvesting small, certain gains. In doing so, they completely ignore the power of compounding and the potential for massive capital appreciation. The dividend chaser is a classic victim of probability neglect. They are so focused on the certainty of their next dividend check that they neglect the much higher probability of superior long-term returns from a great growth business. They are trading life-changing upside for a meager, inflation-eroded income stream. Let's consider two companies. Company A is a stable utility that earns $100 million and pays out all of it as dividends. Company B is a dominant software company that also earns $100 million, but it retains all of that profit and reinvests it back into its business at a 30% rate of return. The dividend chaser buys Company A and gets their regular check. The focus investor, applying the 10x test, buys Company B. In 10 years, Company A is still earning roughly $100 million. But Company B, by compounding its capital at such a high rate, is now earning over $1 billion a year. Its stock price will have followed suit. The dividend chaser has collected a few years of income. The focus investor has built real wealth. The obsession with yield is a mathematical trap that ensures you will miss the very companies that are most responsible for driving the market's long-term returns. The direct financial connection of this pillar is the concept of power law distribution in portfolio returns. Research on long-term stock market data has conclusively shown that the returns are not normal. A very small number of stocks, the fat tail of the distribution, account for a disproportionately large share of the total wealth created. One study by Hendrik Bessembinder found that, over decades, the best-performing 4% of all listed companies explained the entire net gain for the U.S. stock market since 1926. The other 96% of companies, in aggregate, just matched the return of Treasury bills. This is a staggering statistic that should change the way everyone thinks about portfolio construction. It means that if your portfolio does not include at least one of these rare, hyper-performing outliers, you are mathematically destined to underperform. A diversified portfolio of 50 or 100 stocks is designed, by its very structure, to minimize the impact of any single holding. If you are lucky enough to own one of these superstar stocks, its incredible performance will be diluted to near irrelevance by your other 49 mediocre holdings. You will experience the cost of mediocrity. A concentrated portfolio, on the other hand, is a tool specifically designed to harness the power law. By making large, high-conviction bets on a small number of carefully selected companies that you believe have asymmetric potential, you are dramatically increasing the probability that if you are right on just one or two of them, it will have a transformative impact on your entire net worth. You are structuring your portfolio to align with the mathematical reality of how wealth is actually created in the stock market. You are trading the false comfort of the crowd for a statistically superior shot at extraordinary success. Finally, we arrive at our fifth and final pillar, the strategic inaction principle. This may be the most difficult pillar of all to master in our hyper-stimulated, action-oriented world. The 20-slot punch card is not just a tool for making better decisions. It is a powerful mandate for making fewer decisions. The scarcity of the slots forces you to spend the vast majority of your time not buying or selling, but waiting. This is the discipline of patience, the ability to sit on cash for long periods, resisting the siren song of the market and the internal psychological pressure to do something. Buffett himself has said that temperament is more important than intellect in investing. The temperament for strategic inaction, for being able to sit in a room and do nothing while others are frantically trading, is the final and perhaps most crucial ingredient in the punch card philosophy. It is the understanding that in investing, activity is often the enemy of returns. True mastery lies not in constant motion, but in long periods of patient observation punctuated by rare and decisive action. The most powerful anecdote illustrating this principle is not an investment Buffett made, but the thousands of investments he famously did not make during one of the wildest manias in market history, the dot-com bubble of the late 1990s. As the decade drew to a close, the stock market was gripped by a speculative frenzy unlike anything seen before. Any company with .com in its name, regardless of its business model, revenues, or profits, was soaring to astronomical valuations. The old rules of investing were declared dead. Concepts like earnings and cash flow were dismissed as relics of a bygone era. The new metric was eyeballs or clicks. It was a period of mass delusion, a classic speculative bubble. And throughout this entire period, Warren Buffett was a figure of public ridicule. He was on the cover of magazines with headlines that asked, "What's wrong, Warren?" He was mocked as a dinosaur, an old man who just didn't get it. His conservative, value-based approach was seen as hopelessly out of touch with the new digital economy. He steadfastly refused to invest in the high-flying technology and internet stocks of the day. His reasoning was simple and consistent. They were outside of his circle of competence. He admitted he had no idea how to value these companies. He couldn't predict which ones would be the winners and which would be the losers in 10 years. He saw business models that were built on the hope of future profits, not the reality of current ones. And so, he did nothing. He refused to punch his card. He sat patiently, holding billions of dollars in cash, while the market went parabolic without him. The pressure to capitulate must have been immense. His investors were watching their neighbors get rich on stocks he refused to buy. He was underperforming the S&P 500 by a massive margin. It would have been so easy to just dip his toe in, to buy a basket of tech stocks to quiet the critics and participate in the mania. But he held firm to his discipline. He knew that punching his card for a business he didn't understand, at a price that made no sense, was a cardinal sin. His inaction was a strategic choice, a powerful expression of his investment philosophy. Then, in March of 2000, the bubble burst. The Nasdaq index, which had been the epicenter of the mania, began a catastrophic collapse, ultimately falling by nearly 80%. Hundreds of dot-com companies went bankrupt. Trillions of dollars of speculative wealth vanished into thin air. The investors who had mocked Buffett were financially ruined. And Warren Buffett, the dinosaur, was revealed to be the wisest man in the room. His strategic inaction had not only protected his investors from devastating losses, but it had also preserved his dry powder, his massive cash hoard. In the aftermath of the crash, when high-quality, understandable businesses were available at bargain prices, he was ready to act. He had saved his punches for when the odds were overwhelmingly in his favor. The dot-com bubble is the ultimate lesson in the power of saying no. It proves that sometimes the most profitable decision you can make is to do nothing at all. The cognitive bias that makes strategic inaction so difficult is known as action bias. Humans have an innate compulsion to act, to do something, in situations of perceived importance or uncertainty. It feels better to be doing something, even if it's the wrong thing, than to be doing nothing. We are wired to believe that effort and action lead to better outcomes. In many areas of life, this is true. A student who studies more gets better grades. An athlete who trains harder performs better. But in investing, this bias can be lethal. The market is a counterintuitive domain where effort and activity are often negatively correlated with results. The investor who is constantly tinkering with their portfolio, buying and selling based on the latest news, is a victim of action bias. Their brain is telling them that this activity is productive, that they are being a diligent investor. In reality, they are likely just churning their account, racking up costs, and making emotionally driven mistakes. Sitting on a large pile of cash is psychologically painful for someone with action bias. Cash feels like a non-performing asset, a symbol of missed opportunity. Every day the market goes up, the cash holder feels the pang of regret. The urge to deploy it, to put it to work in something, anything, becomes almost overwhelming. The strategic inaction principle is a powerful mental discipline designed to override this destructive bias. It reframes patience not as passive waiting, but as an active offensive strategy. It is the discipline of the sniper who may lie motionless for days, waiting for the one perfect shot. The hyperactive trader, by contrast, is like a machine gunner, spraying bullets in every direction, wasting ammunition, and rarely hitting the target. To cultivate this discipline, you can adopt a powerful mental model: cash as a call option. Most investors view cash as a zero-yielding asset that is constantly losing value to inflation. This view is what fuels the action bias and the fear of holding cash. The correct way to view a cash reserve within a punch card portfolio is to see it as a call option on future market opportunities. A call option is a financial instrument that gives you the right, but not the obligation, to buy an asset at a predetermined price. It has value because of the opportunities it might present in the future. Your cash hoard is a zero-premium perpetual call option on any asset class in the world. When you hold significant cash, you have the right to buy stocks, bonds, real estate, or entire businesses when they go on sale. Think back to March of 2020, during the depths of the COVID-19 panic. The market was in freefall. For the fully invested investor, it was a period of sheer terror. But for the investor who was holding cash, who had practiced strategic inaction, it was the opportunity of a lifetime. Their cash, which had seemed like a lazy asset just weeks before, was suddenly the most powerful tool in their arsenal. It was a call option that was deeply in the money. They could deploy their capital at prices that were unimaginable just a month earlier, effectively guaranteeing themselves spectacular future returns. To implement this model, you must mentally recategorize the cash in your portfolio. Do not view it as uninvested. View it as strategically reserved. Give it a job title, the Opportunity Fund. This simple linguistic trick helps to change your psychological relationship with cash. It is no longer a sign of indecision. It is a sign of discipline and preparedness. Having this dedicated pool of capital allows you to view market downturns not as crises, but as the rare opportunities you have been patiently waiting for. It transforms your entire emotional experience of volatility. It is the ultimate tool for turning fear into greed. The antithesis of this patient, opportunistic approach is the hyperactive trader. This is the individual who is addicted to the action of the market. They are often found on platforms that have gamified the investing experience, with confetti and flashy graphics celebrating every trade. The hyperactive trader is constantly monitoring their portfolio, checking stock prices multiple times a day. They trade on momentum, on rumors, on technical chart patterns. They are always chasing the hot new thing. Their portfolio turnover is astronomical. They might hold a stock for a few days or a few weeks, but rarely longer. The financial consequences of this behavior are devastating. First, as we've discussed, there are the transaction costs and the massive tax inefficiency of constantly realizing short-term capital gains. But the damage goes deeper. The hyperactive trader is playing a game that is almost impossible to win. They are competing against high-frequency trading algorithms and institutional investors with massive research departments. Their strategy of rapid-fire trading based on superficial information guarantees that they will be whipsawed by the market's random noise. They are constantly buying after a stock has already run up and selling in a panic after it has fallen. They are the proverbial dumb money that provides liquidity for the smart, patient capital. The hyperactive trader's need for constant action, their complete inability to practice strategic inaction, is the single greatest enemy to their own financial well-being. Their portfolio is doomed to a death by 1,000 cuts, each trade a small, self-inflicted wound. The direct financial connection of the strategic inaction principle is its role in creating and deploying a margin of safety. This is one of the most important concepts in all of investing, popularized by Benjamin Graham. The margin of safety is the difference between the intrinsic value of a business and the price you pay for it in the market. Buying a stock with a large margin of safety is what protects you from bad luck, unforeseen problems, and your own errors in judgment. It is the bedrock of low-risk, high-return investing. Strategic inaction is the engine that creates the margin of safety. It is by patiently waiting, holding cash while others are euphoric, that you get the chance to buy when there is blood in the streets. Market panics and crashes are the only times when truly great businesses are offered at prices that provide a massive margin of safety. The investor who is always fully invested can never take advantage of these rare opportunities. They are forced to simply ride the market down and hope for a recovery. The patient investor, the practitioner of strategic inaction, is the one who can step in with their opportunity fund and purchase assets for 50 cents on the dollar. This act of deploying capital at the moment of maximum pessimism is where a portfolio's outsized returns for the next decade are generated. Your patience in the bull market directly translates into your purchasing power in the bear market. Strategic inaction is not about timing the market. It is about recognizing that the market will inevitably offer up fat pitches, and having the discipline and the capital to be ready to swing big when it does. That discipline is the final, crucial link in the chain, the guardian of the punch card, ensuring that each precious slot is punched only when the odds of a spectacular, long-term success are overwhelmingly in your favor. You have now journeyed through the 5 foundational pillars of the 20-slot punch card philosophy. You possess a new and powerful mental framework, a tool designed not for the reckless collection of stocks, but for the disciplined and deliberate creation of generational wealth. You have moved beyond the comforting but ultimately self-defeating logic of diversification and embraced the mandate of extreme selectivity. You understand that true safety is found not in numbers, but in the deep competence you build within your own circle of expertise. You have been given the blueprint for cultivating the courage of high conviction, the psychological armor needed to hold your winners and let them compound into transformative gains. You have seen the cold, hard mathematics of asymmetric upside, and why a concentrated portfolio is the only structure designed to harness the power law reality of stock market returns. And finally, you have learned the profound wisdom of strategic inaction, of viewing patience not as a passive state, but as your most potent offensive weapon. But this complete system, this punch card, is only one pillar in the vast, interconnected architecture of a master investor's mind. A powerful pillar, yes, perhaps the most important, but it is supported by other, equally critical models for accurately valuing a business, for assessing the quality and integrity of a management team, and for understanding the deep, cyclical currents of market psychology itself. Knowing how to concentrate your capital is one half of the equation. Knowing precisely what to concentrate it in, and at what price, is the other. The video that is now appearing on your screen is not a random suggestion. It has been selected by a complex algorithm that recognizes you have completed this foundational piece of the puzzle. It has identified the next logical step in your journey. Think of it as the missing link, the mental model that connects the why of concentration with the how of valuation. It holds the key to the next principle in this interconnected network of thought. The average investor, the collector of superficial information, will stop here, satisfied with this single, powerful idea. But you have demonstrated the patience and focus to absorb this entire blueprint. The real question is, are you merely a collector of interesting concepts, or are you a dedicated architect of your own financial destiny? The choice to continue your ascent, to complete your mental arsenal, is yours. The next piece of the map is waiting,